Friends, in this video, I'm going to talk to you on the topic, the case to extend your investment horizon. Everybody has been used to seeing returns come faster to them. From the bottom of COVID, the markets have made it easier to make faster returns. When you start at valuations which are relatively lower, it feels easier to make faster returns. This is never unusual. When the markets saw very low valuations in earlier instances, especially in the small and mid cap category, over a decade, the markets more than compensated for those periods of low valuation. We were given or rewarded with periods of excess valuation. Now, the swing from a period of low valuation to a period of excess valuation was remarkable. That is how people had their multi-baggers. They had businesses in their portfolio which changed the fortunes of their portfolio. Both individuals and professionals alike saw their total portfolio value grow. The assets boomed. All this was possible because of the extremes in valuation. Now, we rarely have that luxury. COVID briefly gave us a phase where that luxury returned to us. But again, today, if you are scouting for opportunities, you don't find opportunities at valuations that you really like. The valuations are good but not great. The distinction between the two is quite significant. Now, the valuations we see make it necessary, essential for us to have longer extended investment horizons. What would that change to our outcome? What can we expect from a longer investment horizon? Firstly, the growth of businesses gain momentum over longer periods of time and then have a period where faster growth happens over a longer period of time. They hit a purple patch and then you see performance like you see in a home run. That phase must be waited for. Most of the time we find that investors buy stocks at favorable valuations and then when they double or triple, tend to sell them to book profits. The stocks go 10x from the price at which the investors sold. This also adds the layer of reinvestment risk. When you sell a stock, you need to buy a stock as good as what you sold, if not better. In markets like the present market, that risk is rising and it's threatening investors with poorer outcomes, which is why if you have a portfolio of good stocks, you must reduce the churn and be ready to give more time to your stocks so that the stocks stay with you at least one cycle longer and by virtue of that deliver superior investment returns. The difference between owning a stock for one cycle and 2 or 3 cycles is significant and very underemphasized because businesses gain size with every cycle and in the 3rd or 4th cycle, the company may add profits every year what they made in the entire first cycle. You can imagine what would happen to the valuations. The valuations will accelerate and compound much better in later cycles. This is the case for holding stocks for extended periods of time. And India is going to see reasonable growth for extended periods of time, and that economic growth should translate into superior investment growth in businesses. Companies you see today at 2,000-3,000 crore valuation can become billions of dollars over decades. That is not an opportunity you want to miss out, right? As an individual investor and as a professional, my belief is that I should ensure that the portfolio gets the benefit of owning stocks for such horizons. I should not rush to book profits simply for feeling the adequacy of profits. You must allow positions to run and make money across cycles. I know most of us are used to making money in one cycle. Now, the time has come when you should wait for multi-cycle investing, and that mindset will help you hold companies for extended periods of time, for a longer duration, only to be rewarded significantly better than you are in one cycle. Thank you for watching this video.